Hello, it's Brian Resnick's question and answer day. And one of the questions that is coming up a lot is about interest rates going up or down, the inverted yield curve and recession. One of the things I want to address is this. An inverted yield curve, meaning short-term rates are higher than long-term rates, does not guarantee a recession. It does bring up a few warning points. But I'm going to say this. Interest rates always are going to go up and they're going to come down. They're going to go up and they're going to come down. It's a fluctuating mechanism. Interest rates overall, in my opinion, have come down too far, and we're starting to see them tick back up. This is normal. I think a lot of investors overloaded the boat in the wrong kind of fixed income or bond investments in the last couple years, in my opinion. I think they were under allocated to equity type investments in the U.S. That's what we're seeing a lot from new clients that are hiring my firm this year and actually from last year. The Wall Street firms, the banks got it 100% wrong. They were all calling for recession going into 2019. We're not, folks. But I do see interest rates staying low and potentially moving lower. Do I see them going to zero? No, but there's always that possibility. What I will say, though, because interest rates are generally really low, I see investors making the huge mistake of going out on the maturity or yield curve to get a little bit extra yield on their money. Retirees are in the wrong place, in my opinion, and the wrong allocation to equities versus bonds. They're over allocated to bonds. They're under invested in equities. I think you need to look at how you're invested your money and understand the risks really involved. When interest rates are this low, and you're going for these longer term durations for a little bit more interest, it's like kind of stepping in front of a steamroller for a penny. You could lose your life. You could lose a lot of money buying long-term bonds. In our opinion, you need to be short-term in nature, 1 to 3 year average maturity, high-grade corporates. Stay away from junk bonds. I would stay away from emerging market bonds, short-term treasuries, floating rate type treasuries would be okay. We have reduced or completely eliminated all of our floating rate bank loan funds out of our portfolio currently. I would again be looking at high-quality corporates and treasuries, some floating rate on the interest on either one of those, and on a short-term duration, generally speaking, under 3 year average, 1 to 3 years. I think that's a smarter move. Interest rates will probably stay low for a long time because a lot of the rest of the world is at zero or negative rates, and that's one of the reasons I feel that the rates have come down. Investors overseas are buying U.S. bonds. It pushes those rates down. It was overbought scenario, so rates have basically backed up a little bit. But anticipate low long-term rates potentially for many decades to come. If you're not a client of our firm, it's time you became a client. Call Resnick Wealth Management for a consultation. We manage larger portfolios, $500,000 and up. You make sure you have yourself a safe and profitable day.